Hello and welcome. You're joining us live from the SBI Live studio, and this is ET Now. You're watching Closing Trades with me, Sneha. With me, as always, is Shrishti Sharma. And Shrishti, no complaints about the kind of day we've seen today. You know, little off the highest point, but not much to worry about because 25,300 is something that we have still held on to. We're intact above that mark. Sensex 0.3% uptick coming in. It's actually banks that have turned their tide today and seen a little bit of an acceleration because 0.5% higher is where the banking space is right now. Just want to take a look at what the broader end of the market is doing. Mid caps slightly under pressure, a 0.1% cut coming in on that front. But the small cap space, yet again for multiple days in a row now, continues its outperformance over the breadth of the market. A 0.5% uptick coming in on the small cap index. In fact, in tandem with where the Nifty bank is trading. If you take a look at the winners and losers today, it's Tata Consumer after they've announced price cuts at their new tea launch event coming in. They've said they'll be passing on the benefits of tea and coffee price cuts, and this will be seen by Q3. So on the back of that upbeat commentary, you have Tata Consumer that's up about 4%, followed by SBI that is paring its stake in Yes Bank to SMBCs. You have BEL, Maruti Suzuki, Kotak, Ultratech, M&M. All of these are your top Nifty gainers. On the flip side, some pressure being seen on HDFC Life, a 1.5% cut on that front, followed by ITC, Tata Steel, Bajaj Finserv and Titan. Well, Shrishti, these are some stocks from the index. You also have lots of action in the broader markets today, and it's largely been a stock-specific day for us.
Well, yes, the broader markets, when we look at the index, then it is the mid-cap index that has come off its day's highest point, now trading in the red, while the small-cap index is still in the green. But one of the counters that is indeed in focus today is Vedanta, because it's NCLT that has once again deferred the hearing of Vedanta proposed demerger till 8th of October. The Oil Ministry did not raise objections to the demerger per se, but had concerns over the bank dues. Let me take it across to Anurag Joshi, who is joining us with all the details. Anurag.
The National Company Tribunal's Mumbai bench has set October 8 as the next date to hear the petition on the Vedanta demerger matter. Now, the key thing which happened in the hearing today was the lawyer representing the Oil Ministry raised objections linked to Vedanta's unit Malco Energy, which has been allocated certain oil blocks by the government. The Oil Ministry's objections are on the contracts linked to the energy blocks, which have been allocated to Malco, a unit of Vedanta. And the government said that, the lawyer said that they have raised a demand of 5,600 crore rupees from Malco and has declared that Vedanta these blocks have been allocated, which were allocated as assets, were, actually secured to get bank loans. That's what the Oil Ministry lawyer. The Vedanta lawyer said that the company board has approved a corporate guarantee which is favoring the government for the oil blocks allocated, and the board has already cleared that, and it has made all the statutory disclosures. And another key thing which the Oil Ministry lawyer made at the hearing today was highlighting 4 risks, which according to him are the financial risks following the demerger of Vedanta, misreading of the hydrocarbon assets, insufficient disclosure of liabilities, and also violation of the listing rules. Also, the NCLT has the SEPCO, which is a Chinese power engineering company. They had a dispute with Talwandi Sabo, which is Vedanta unit, and both of them had settled their disputes on September 11. So that was brought to the notice of the court, and the SEPCO lawyer, in fact, mentioned that they're not challenging the demerger plan and they've withdrawn the intervention application in the matter.
Thanks so much for taking us through all of those details. So that's the ground update coming in from the NCLT on the verdict on the Vedanta demerger matter, and now that has been deferred to the 8th of October. But we also have Kunal joining us on the studio on the technicals, and we have Mr. Vinay Jaisingh, CIO and Head Equity Advisory at ASK Private Wealth, also joining us on the fundamentals. But Kunal, let's come to you first and help us with a chart check on Vedanta. You know, we were talking about this stock in the morning and no definitive outcome yet, still some roadblocks in the way of its demerger, but the management continues to remain positive that this could happen in FY26 itself. While that is on the fundamentals, give us a chart check and how Vedanta has been shaping up of late.
Well, good afternoon. So I think Vedanta has been a huge underperformer when you compare this to the risk of the rest of the metal pack, because at one point of time, metal stocks and the metal indices have gone through a breakout. Vedanta, on the other hand, has gone through a major struggle. The stock formed I think, a high in 2024 around the 520, 525 mark. From there, it had fallen more than 20%, came down to sub 400 levels. And now, even at current levels of 460, 470, the stock is still showing signs of extreme volatility. Now, the only concern with stocks like Vedanta is that metals, as it is a very high beta sector. Now, within that high beta sector, you generally expect that once stock pick up pace from their immediate bottoms, you would expect that the pace of or the beta of these stocks, they generally drop down. But the concern with Vedanta is that even at higher levels, even after a phase where the stock recovers from its lows, comes back to a resistance point, breaks out the resistances, that beta doesn't drop down. That, I believe, is the concern for a short-term trader to try and carry forward heavy-sized positions. So I think in that aspect, I would believe that the stock may continue to underperform till the time this odd or the strange nature of the price behavior in terms of beta continues to behave with respect to the pack from the metal sector.
All right, so that's about Vedanta, how the stock is seen to be shaping up. And yes, of course, the metal as a pack continues to be volatile today, because after 2 stellar days of run-up, some of these stocks are taking a bit of a breather. But on this topic itself, Vinay, firstly, hi, good afternoon. And what is your own sense on metals as a pack? Because of late, that is seen to be catching steam. But what is your opinion right now?
So on a bottom-up basis, we do like the infrastructure space or the capex space because we believe the capex, which has slowed down last couple of months, would come back. Having said that, we are seeing the dollar has firmed up a lot, and we expect the dollar to weaken as well. So, on a selective basis, we are looking at metals for sure, but we think there are better infrastructure plays out there to buy. Case in point, pipe companies, case in point, port companies, tube companies, cement companies. So we prefer those among the metal basket, but there would be one odd name in metals which we do like.
That's the take coming in on that theme. But on that note, Vinay and Kunal, stay on with us. We'll slip into a very short break and talk more about the day we've seen in the market and the market setup for the near to medium term, just on the other side.
Welcome back to Closing Trades right here on ET Now, where you are catching us live from the SBI Live studios. And let's take the discussion forward, and let me welcome Nagraj Shetty on the show. Hi Nagraj, good afternoon and good to be speaking with you. And firstly, help us with your take on the markets and any particular sector that is looking good to you, because it's a lot of sector churning, and I believe that today is the day of just PSU banks.
Hi, good afternoon. Nifty has been in a continuous uptrend over the last many sessions. What we can observe, high tops and higher bottoms. The recent consolidation movement has been taken out, and Nifty is clearly headed higher. The overall chart pattern is looking positive, and I'm expecting Nifty to move towards the 25,600, 700 levels in the near term.
So that's the chart setup coming in on PSU banks. But Vinay, what is your view on the entire private banking space? And we've been asking this question to a lot of analysts and market experts who've been joining us, because Q1 was not all that good for private banks and their NIMs, their credit costs, and that pressure is expected to sustain in Q2 as well. When are you seeing any sort of recovery coming in for the private banks and the larger banking names?
So my perspective, we believe the loan book growth is close to bottoming at about 10 to 11%. What the government has done on GST as well as on the tax front should lead to some loan book growth coming in. And the festive season, as we talk in the next month, you should see some positive movement coming up for the private banks as far as the loan book growth is concerned. Having said that, you're looking at one of the most efficient banks in the world in terms of OPEX, and it's not a bad idea for us to be underweight the private banking sector, and probably being a little more overweight NBFCs would also gain from the loan book growth, as well as be overweight, let's say, the capital marketplace in the segment of the financial sector.
All right, so that's about the financial pack right now. But Vinay, what's your current take on the insurance pack as well? Because what we get to understand is that the whole ITC burden For now, the government-owned insurance companies will be absorbing that, while there could be a hit for the private players as well. And along with that, the intermediaries, the aggregators over there like PB Fintech, they are also going to feel the heat with almost 2 to 3% hit on their financials. How are you placing your bets for the insurance sector, if at all?
So we clearly believe what you said is true. The competitive landscape is only increasing. The number of players are increasing. Fintech is taking a stronger stance in the insurance space. So though GST could be a key beneficiary for those taking insurance policies where the rate could be a little bit lower, but considering the landmark, we are underweight the insurance space as well. For us, when we're looking at the financial space, we're looking at PSU banks, we're looking at certain private banks, a lot more NBFCs and affordable housing, and then moving to capital marketplace.
Okay, so that's the take coming in. Vinay, thanks so much for your time and appreciate you speaking with us on ET Now today. Thanks once again. Okay, let's move away from fundamentals and throw the light on technicals and take it across to Kunal. Kunal, which stocks are looking good on a BTST basis? Anything that stands out from trade today?
Yeah, there are a couple of names which have started to look attractive. PSU banks, of course, remains to be one of the top themes. So you can't miss out on the PSU banking's lot as such. So I think SBI, of course, remains to be the top draw from the entire PSU bank. The stock confirming a breakout of a massive, triangular pattern, which it had been consolidating for the last, I think, 4 to 5 months. So that I believe could be a very strong trending move on the upside. 880 could be a target for the stock in an immediate term. Stop loss could be trailed to 830 for SBI. The second would be a buy on Warren Beverages, and this could be a bit of a high risk or a contra call, because my sense is that the stock is coming out of a major corrective wave from 520.25. The stock had corrected towards 460, 465 mark. Good evidence in terms of the short covering data which we've seen today for the stock over the near term. So which means we could be looking at a turn for the stock. Puts a risk to buy with a target of 490, stop loss at 460.
So SBI and Varun Beverages looking good to Kunal right now. In fact, SBI is soaring away in trade like we were talking about earlier. They've divested 13.18% stake in Yes Bank to Sumitomo Mitsui Banking Corporation. This involves a transfer of 413.4 crore equity shares of Yes Bank. The shares have been sold at 21.5 rupees per share. Just want to see where Yes Bank is trading right now. And well, yes, 21.07, so thereabouts 21.5 is where the deal happened. But that also 21, that mark that we're seeing right now, is after a little bit of a spike on that stock. The deal consideration amounts to roughly 8,889 crores. And that's the news coming in on SBI on the back of their divestment of this 13.2% almost stake in Yes Bank. So that's the reason why Yes Bank is soaring, and SBI also looking good to Kunal on the charts. But Nagraj, what about you? What's looking good from a BTST perspective?
Yeah, I have two stocks from a shorter side. One is Gensa Tech, and second one is Arvind. Technically speaking, Gensa Tech has been in a larger consolidation pattern from the IT space. Recently made an attempt of upside breakout of the range movement, and the follow-through up move has been taking place in the last couple of sessions. Overall chart pattern is looking positive. I think the bigger upside is likely to come from here onwards. Currently trading around 837. Immediate target would be around 885, and one can place a stop loss at 810. Second one is Arvind Limited. Arvind Limited has witnessed a sharp buying recently from the lower levels. After a small downward correction, it has witnessed sustained the upside. The overall chart pattern is suggesting some rounding bottom type pattern, which consolidation breakout. Currently trading around 333. One can look to buy Arvind at current price, and the upside target would be around 353, and one can place a stop loss at 320.
So those are the calls coming in from both of our experts. Let's watch out for that. But with this, viewers, it's time now to slip into a very short break. Don't go anywhere. Lots more to talk about on the other side. Welcome back, and you are catching us live from the SBI Live studios, and a lot's been happening in the markets, because in the last 15 minutes or so, it's once again the steam that is catching up on the markets. Nifty 50 is now once again back to those days highest point with almost 100 points of gain, and even Nifty Bank 365 points of gain is what we are holding at, and all thanks to the PSU banking stocks for today. But other than that, let's move on and let's get you an ET Now exclusive then. And Finance Ministry held meeting with various other ministries and departments on new avenues to grow the capex. The government is aiming to improve the capex for FY26. My colleague Prakash is here with more details on this one. Prakash, over to you.
Well, what we're learning from our sources is that the Finance Ministry has held a meeting with various ministries and government departments on capital expenditure. In fact, we're given to understand that the current status of capital expenditure has been reviewed and new revenues are being looked at, a very significant development coming in. We're given to understand that the government is exploring new revenues to improve capital expenditure beyond rupees 11.21 lakh crore for financial year 2026. In fact, the overall capex may increase to as per demand in the economy. As you are aware that the ministries like railways, road transport and highways, ports and shipbuilding have been traditional growth drivers for capex, and therefore government at this point of time on one hand, assessing potential capacity of traditional sectors and looking for new avenues for capital expenditure. In fact, sources are also informing that the government capex may be expanded to new segments like urban infrastructure and sunrise sectors. Government sources are also indicating that the Finance Ministry is satisfied with the current pace of spending and expecting infrastructure activities to gain momentum after the monsoon season.
Okay, so that's the take coming in on Finmin and their capex expectations across categories. Prakash, thanks so much for taking us through that. We also have Ashi Anand, founder and CEO at IME Capital, joining us on the show. And Ashi, hi, afternoon, and thanks for your time today. My colleague Prakash was just highlighting the capex spends and the pattern that the government has followed so far, and how the private sector is also expected to contribute towards this entire capex spend that we're seeing. Give us a sense of where do you think the government and the private capex spends are heading, and how or what that could mean for our overall infra sector.
Great. Firstly, thanks for having me on the show. It is actually very interesting because if you just look at the markets and you just step back a couple of years, 2023 and 2024, the entire market rally was really driven quite significantly by capex, real estate, all forms of capital formation kind of sectors. This has actually taken a bit of a breather over the last year. And if you just look at what's been happening, the entire 2023 to 24 move in terms of the capex revival was largely driven by a pickup in government capex, while private capex still continued to lag. You now have kind of government capex at a fairly high base. And what we have been seeing over the past couple of budgets is you no longer are kind of increasing capex spends higher than the overall budget. And therefore, it is very, very important for the private sector to kind of come in and actually start contributing in terms of capital formation and capex for this kind of segment to continue to drive market performance going forward. I think it's still fairly early days. You still have reasonable amounts of unutilized capacities. You do need to have some clarity around what's happening on global trade. But any kind of signs of a revival in kind of capex, especially private sector capex, could actually really help the market get a whole new leg of growth up. And the the capex theme, which has been kind of underperforming over the last 6 to 9 months, could actually start to come back.
All right, so that's the day coming in on select pockets, which can be a beneficiary with respect to the whole capex story once again coming into flavor. But other than that, the PSU banking space is doing very well today. Just yesterday, we have seen those private banking names like Axis and Kotak Mahindra Bank doing the heavyweight lifting. But today, stocks like SBI, other than that, some of these counters like BOB, Canara Bank, PNB, they are actually up anywhere between 2 to 4%. But Nagraj, help us understand what is your preferred bet within the PSU banking space? Any stock where you feel that's still offering very good opportunity?
I think in the whole host of our PSU basket is moving up with this news, and SBI, of course, certainly leading from the front. And overall chart pattern for the SBI is looking at decisive upside breakout of the larger range movement. That is the one which is likely to lead the sector further. And the second, the Canara Bank and Punjab National Bank are the one which are showing some significant moment after the consolidation moment. So PNB, Canara Bank, and State Bank are the one which are likely to show a continuation of uptrend from here onwards.
Okay, so that's some of the names that are looking attractive to Nagraj at the moment. Just revisiting what the market is doing, because like Shishti was mentioning, we've seen that little bit of an uptick coming in the markets. So 25,333, almost at the day's highest point, a 0.4% uptick coming in for the Nifty. You have Nifty Bank that is also picking up significant steam, because 0.6% uptick is what we're seeing on Nifty Bank right now. And it's actually SBI that's driving that rally, a 3% uptick now on SBI, followed by Kotak. Kotak was up 1.5% yesterday as well. In fact, it's 1.5% today, and it was up 3% yesterday. So good moves coming in from Kotak as well. But while we're talking about the banking space in SBI has said it has completed stake sale in Yes Bank worth around 8,900 crore rupees. The lender sold stake in Yes Bank to Sumitomo Mitsui Banking Corporation, belonging to the Sumitomo Mitsui Financial Group. Ankur is here with more details on the stake sale. Ankur.
Yes, the deal is getting implemented, and we have learned today that State Bank of India has now sold their stake in Yes Bank. Still, after this announcement, 10% of the stake remain in Yes Bank. Total consideration was around 8,800 crore, and this was on a pre-agreed price of 21.5 per share. But not only the State Bank of India, there has been other deals as well. You would have seen there was a block deal which was there in Yes Bank a week back, and more than that, the 4.2% stake of Carlyle Group has also now been sold to Sumitomo Mitsui Financial Group. Now, this is important because you remember that Reserve Bank of India had given approval for a stake sale of up to 24.99%. And now, after this stake sale, the total stake which Sumitomo Mitsui have bought is 24.2%. So overall, 20% stake sale was a deal which was announced during Yes Bank, whereby State Bank of India, of course, being the largest lender, has got an exit with around 10% stake remaining. But other banks like Kotak Mahindra Bank and Bandhan Bank, among others, were also part of that stake sale. So overall, now the deal is getting implemented. Reserve Bank of India and CCI has already given approval, and finally, we may see this getting completed in this quarter itself, as it was guided by the management earlier.
All right, thank you so much, Ankur, for getting us all those details. But Ashi wanted to have your take on this one, because this was very well known that some of these banking majors will take their hands off SBI, and Japanese bank SMBC will be taking over. Along with that, Ashi, help us understand specifically on Yes Bank, how do you see this whole story unfolding? Do you believe that it can be a good story going ahead in terms of the financial improvement? What's your overall take on this one?
Sure. So firstly, I think I must commend the kind of government in terms of the way they handled the whole Yes Bank kind of blow up. You have actually had a bunch of financial firms go and rescue the company, and actually in a manner where they've actually made money in that entire rescue attempt. So that is kind of, it is probably an extremely well kind of done recovery that has happened for Yes Bank. Now, in terms of the kind of path ahead, Yes Bank was a kind of largely institutionalized SME lending kind of bank, and doing much more aggressive forms of structured lending, lending to kind of loans against shares, loans to promoters, etc. Now, this was very high yielding, and it's really what helped Yes Bank generate the ROA, but it's also what actually led to all the trouble. The transition of Yes Bank away from this large institutional towards a more retail-oriented bank, where kind of credit costs are more manageable, where also you have a certain level of diversification in terms of your lending, that is actually a transition which is still underway. It is still probably too early to really indicate whether that is a success or not. Now, within that kind of context, we actually prefer a lot of other banking names where the strategy is a lot clearer. They are implementing on a known strategy that is working. And there is no shortage of attractive kind of banks to buy, banks of reasonably high quality available at decent valuations. And which is where we'd actually prefer some of those as compared to kind of taking a bet on a bank which is still in the middle of a transition, and what the kind of eventual outcome is in terms of the transition, how they'll manage credit costs and the new segments. A lot of these answers are not yet known. And which is why, at least as an Yes Bank, it's something that we are at least not looking very closely at.
For that view coming in, and stay with us. We'll just slip into a very short break and be right back. Talk more about the day that was.
Welcome to the CT Now special, and today is that very special day when a household name became a script, and what a grand debut on the bourses they've had. To celebrate this moment, I have with me the three co-founders, Abhiraj Behel, the CEO that is, the COO, also Varun Khetan joining in, and Raghav Chandra, the CPTO, all co-founders of what we know today as Urban Company. And Abhiraj, if I could start off with you, what a bumper listing you've had. How does it feel?
Thank you, Aisha, for having us. It definitely feels, still settling in. Feels surreal, feels very joyous. But at the same time, we recognize that, this kind of reception that we've got and the love that we've got through this process and today is more a reflection of the faith people have in the company in the future. It's not a function of who we are today. It's a promise of the future, and the onus will be on us to deliver on that promise. We're a relatively small company in the scheme of things, and that's not lost on us. And whatever we've seen today, we take it with complete humility, and we see it as a responsibility for the future.
Oh, absolutely. And Varun, are you rehearsed enough now to answer questions on margins, profitability, etc.? But I really did want to understand that because, now the market is going to view Urban Company from a very, very different lens. What do you foresee in terms of both your margins and profitability going forward?
We look at our business, Aisha, in 4 different segments. There is our India core services business, which has all the home and beauty categories. That business turned solidly profitable in FY25, and it's the most mature part of our business. In the quarters and years to come, we want to continue to invest in growing that business, at the same time demonstrate improving margins in the India core services business. There are 3 other business lines that we called out in our RHP. There is our international services business, native line of products, and the InstaHealth service. All of these 3 are at this point in investment mode. They are newer businesses at different stages of maturity. We want to continue to invest behind growing these businesses and also improve their margin profile in the times to come. Overall, the goal is to think long-term and continue to build a enterprise that will be only valued on its profits. The more short-term will depend on the stage at which every business line is in, and we'll continue to disclose more details in the times to come.
Sure. Raghav, if I could get you in on the discussion, how does Urban Company differentiate itself from a traditional offline player in the very fragmented home services market now that you're a listed entity?
Yeah, I think we got into this space when we realized it's very fragmented, has very poor quality standards, and requires organization. And that's what we've kind of over the years built. We take pride in having invested in various parts of the supply chain, starting from training our supply well to innovating on all the products and tooling which get used on the job. We work very hard to have the right quality metrics, assist the partners on the job. And all of this is basically to make sure that the jobs are getting done with very, very high quality. And what this does in return is enable partners to earn a lot more through their as they kind of go around delivering jobs for the month. So this is kind of how we've organized our marketplace and what we believe we do differently from the offline unorganized world.
Right. But Abhiraj, let's look 5 years hence. How is it that you at Urban Company plan to now deepen penetration in existing Indian cities before perhaps expanding into newer geographies?
Aisha, I think we have a very simple framework to look at the promise for the consumer, which is faster, cheaper, better. When we started our service marketplace, getting a service the next day at a predefined time was in itself an innovation. Over time, that moved to same-day delivery, and now, people want the service delivered within 30 to 45 or 60 minutes. So faster is definitely one of the key pillars on which we want to differentiate. Better is very important for us. One of the things that sometimes is overlooked is the amount of investment we put into going deep into every service category, whether it's in the tooling, the consumables and products, the SOPs, the training, the supply chain. As an example, we would have done a mini PhD inside Urban Company on all types of stains possible in your home. What are the chemicals needed to remove those stains? In appliance care, we've launched our own proprietary diagnostic devices, which give a real-time second opinion over what the technician is saying. So we really go deep into every service. We don't feel shy of getting our hands dirty and trying to innovate. And that, in our view, unlocks the axis of better. Unless the service quality and the service experience is distinctly better from the offline, consumers won't switch. And the third is, of course, cheaper, which in some sense comes from scale, comes from deeper penetration in our micro markets and better utilization of our service professionals, which leads to higher earnings for them and better pricing for consumers. So faster, cheaper, better, those are our simple pillars. If we continue to execute on those, we believe we will continue to penetrate both in our existing cities and existing service categories, as well as newer cities and newer services.
Sure. But Abhiraj, the Indian industry itself, the TAM is about what, $60 billion as of FY25 and projected to grow about $100 billion by 2030. How much share can online players very realistically capture and how?
You're absolutely right, Aisha. I think in the last year, this market was about 5.5 lakh crores and expected to get to about 8.5, 9 lakh crores over the next 5 years. And a very small percentage is online today, less than 1%. And, if I put all of our companies together, including Urban Company and the several others who are in the space, the organized online place is a minuscule today. It's always hard to predict where this could be. But, if we look at other categories, and as an example, if we look at Amazon when it went public in the US back in the 90s, and less than 1% of retail was online, over the next 20, 25 years, it was successfully able to take a sizable percentage of that market online. And we believe the same is possible in services, particularly given urbanization, particularly given nuclearization of families, online penetration improving, and also for service professionals, there is a real aspiration to no longer be in the informal economy, to be part of real India, go through training and certification, to earn a decent, respectful middle-class life. They have that aspiration to be part of formal India. And I think both sides will propel this transition from unorganized to organized and offline to online.
Okay, that's the word coming in from the management of the newly listed Urban Company, and what a bumper listing they've seen today. But on that note,